All right, hi there, guys. If you haven't already seen video 1 of this 5-part series, I would highly recommend that you go back and you read that one. And it's all about the difference in timing of cash and economic value being either created or consumed. These videos are necessary to be able to put together a personal income statement, which is different from our cash budget. A very, very critical video, that first one was. In this one, we're going to be looking at the second, which is the second item related to timing differences. And this one is called deferred income, okay? The first one, accrued income, where you've earned or created the economic value, but have not yet received payment. Deferred income is where you've received the payment, so you've received the cash, but you have not yet created that economic value. So you may be able to answer the following question. Have you ever had money in your account that you hadn't earned yet? Okay. It feels like income, but it isn't. In the last video, we looked at situations where you've earned value, but haven't collected the cash yet. And what we discussed was that you would record that as income that you've earned, whether it's accrued income or accrued interest, and you would create an asset because someone owes that to you. Now we're going to flip that around. Sometimes you collect the cash first and the economic reality comes later. So in this case, you've collected money, but you haven't yet earned it. And we want to go through a couple of different examples to explain this. So firstly, rent collected in advance. So let's say that you rent out part of your home. Okay, very common scenario if you are acting as a landlord. And let's suppose that your tenant has paid next month's rent early. Sometimes it's common practice to pay first and last, in which case you've received money for that last month's rent, but you have not yet earned that money in terms of providing the space, the rental unit for them for that specific month. So what have you collected? The cash is already in your account, but what's the economic reality? You haven't provided the housing for that period yet. Okay, so is this income? No, not yet. Because income is value you've earned, instead, you now have an obligation, and that's called a liability. So a liability is an obligation to provide value in the future. So we would see this type of transaction come up in our cash budget, but we would not see the creation of the obligation in the cash budget. And this is why we need both income statements and what we will get to is net worth statements as well. So now imagine someone pays you upfront for a full year of service. Let's talk about an annual subscription, okay? You collect all that cash today, but have you earned it? No, you're going to earn it over time. So economically, the value hasn't been delivered yet. Until you provide the service, you owe something. Okay, a good example here would be if someone was paying for, say, landscaping services all up front, you would receive that cash all up front, but you've not yet delivered the economic value. So you owe that economic value, which is equal to the amount of cash that you've collected. And each month that you provide that service, that liability reduces and the income is reported to reflect a true economic reality of you with your landscaping company. So the insight here is that until you provide the service, you owe something. Last example, say prepaid lessons or training of some sort. Think about prepaid lessons like tutoring, coaching, or training. Someone pays you for 10 sessions up front. You could also think about, as a lawyer, you may receive a retainer. You've received the retainer, but you've not yet produced the economic value. And so the economic value is a liability until you've actually delivered that value. So again, you've collected the cash, it would show up in your cash budget, but you haven't delivered all the sessions yet. Our other documents keep track of what is owing. So you haven't earned all that income. The insight again is that you're holding cash, but you still owe work. So the situation where you collect cash before you've earned it is called deferred or unearned income. Deferred income is equal to cash collected before the value is earned. And every time this happens, cash increases, so it shows up in your cash budget, and the liability associated with that, this deferred income, increases as well. If you've collected cash but haven't earned the value, you don't have income, you have a liability. In the last video, value came first, cash came later. Now, cash comes first and value comes later. In our next video, we have to deal with the expense side and look at what happens when you've already consumed value, otherwise known as an expense, but haven't paid for it yet. Once you understand all of these timing differences, you'll see why just tracking what you collect and pay doesn't tell the full economic story. We will need the personal income statement to do that, and we need to work through topics 3, 4, and 5 in preparation of creating that income statement. If this has been helpful to you, created value for you, be sure to like it, subscribe to the channel, and get alerts for when new content is created.